Once again, I have the honor and the privilege of interviewing Sebastian Rivera, Senior VP of Intercoastal Mortgage. I'm Adrian Small with TTR Sotheby's International Realty. And what I did this time, as I've done in the last couple of sessions, is do a deep dive through the internet. Why? Because a lot of people use AI or just Google questions asking about the concerns that they have related to the mortgage industry. So based on that, I put together a number of questions for Sebastian. So without further ado, Sebastian, good morning.
Good morning. How are you?
I am good. So I'm going to start with the first one. Everyone is Googling interest rate predictions for 2026. Instead of asking for a crystal ball, let's talk strategy. If a buyer waits for rates to drop to 5.5, what is the risk that home prices will rise and wipe out those savings?
There's a big risk of it. So as mortgage rates decrease, affordability will increase. And as affordability increases, more people go into the market to purchase the same home, which drive prices up. So the lower rates get, the faster appreciation are going to be seen in the market, and it's going to be more difficult for those newer buyers to get in. Now, if you're an existing homeowner and you see rates drop, you will see additional value go up in your house, and you'll be sitting on more equity for sure.
I'd like to put in a little caveat there.
Yes.
I agree with your strategy, but there's one part of it that I think would modify, which is sellers, when they see interest rates lowering and have been sitting on the fence but have the need to sell, will put their houses on the market. So let's just say that into your comment, I increase the volume of homes on the market, what the effect would be then.
Oh, for sure. So I can tell you even from personal experience, locked in at a 2.25 rate, swallowing a 7% rate was difficult. Now that rates are in the low sixes, high fives, my wife and I are actively looking again for another home because rates have become to a more affordable spot. So as a seller looking to get into another home, yes, absolutely. You're going to be seeing more inventory this year in the market.
Don't you think, right? So don't you think that if there is more inventory in the market, that increase in value will sort of stabilize?
It will over time, but we need to see the effects, the overall effects of how much more inventory we're going to be seeing. The big ticket on the news yesterday was Trump coming out and putting a ban on institutional investors, which are 5% of the market purchases. That should be interesting. I'm curious to see how that plays into prices of the market, because if you have 5% of all sales basically stopping, these big corporations going in and buying up entire neighborhoods, and all of a sudden they're not, how will that affect the demand? It's 5%. It's not a huge segment of the market, but it's definitely noteworthy to see how it'll impact our area at least.
Can you explain to my viewers what is an institutional investor?
Yeah, one of these big, massive funds worth billions of dollars coming in and saying, "Wow, Vienna, Virginia is appreciating quite nicely. Let's go in and spend $150 million in January and another 250 in February, another 350 in March to buy up homes. We don't care if they sit vacant. We just want appreciation over time. And when the time is right, we flip them, or we keep them and we rent them, we rehab them, and do whatever we need to." So it's these massive companies coming in and buying big chunks of real estate, which otherwise would have been intended for first-time buyers or for homeowners or for any segment of buyers.
That include land bankers?
I'm not sure. No, there I'm not sure.
Okay, because I see large institutions, because I have several land listings, coming in and just wanting to purchase the rights so they can develop them later. They use the rights for, let's just say that you have a property you have land in Marshall, Virginia, and you want to develop something in Winchester. You can go in and buy the rights there to be able to develop Winchester. And these are very large corporations doing that kind of land banking.
I wouldn't think it would be a restriction based on the current administration's strategy, but I'd have to look into it. I'm happy to look into that one.
Okay, that's a interesting thing that we can
That's
talk
a really
about
interesting
next
question.
time. Yeah.
Yeah.
Okay, so I'm seeing a lot of interest in temporary buy downs like the 2-1 buy downs. Can you explain to my buyers in simple terms how this lowers their payment for the first 2 years and why it might be better than a permanent price reduction?
Yeah. So a buy down, you're buying down the interest rate for a temporary period. A 2-1 buy down buys it down 2% for the first year, 1% for the second year. A 3-2-1 buy down buys it 3% for the first year, 2% for the second year, and 1% for the last year. So it's just a temporary reduction of interest rate to help those lower payments going during those initial years. They're great products for some instances. For example, I had an attorney recently who during the next 2 years will be making a 150 base without any bonuses. At the beginning of year three, she'll be eligible for the first $500,000 bonus. So the 3-2-1 buy down is amazing. It gets her the cash flow she needs during that period. And once her bonus structure kicks in, she'll have more than enough to pay it off or do whatever she likes. It also helps mitigate high rates. When we were doing 7.5 interest rates, getting a 2-1 buy down to 5.5% that first year and 6.5 to the second was huge for a lot of buyers. It's a cash flow relief, temporary cash flow relief for a determined amount of time.
Can we say that at the end of that period, if rates were lower, they can always refinance, right?
Yeah, or even during. So one of the common questions is, hey, Sebastian, I have a 2-1 buy down right now. You helped me get this 2 years ago, but rates are now at a point where it makes sense to refi. Am I going to lose the money that we prepaid into this? The answer is no. When you refinance, that money goes directly back into the principal.
Wonderful. So many of my clients in Bethesda and Arlington are sitting on a 3% mortgage rate and they feel stuck. Please explain how can a bridge loan or a HELOC help them unlock their equity to buy their next luxury home without selling their current home first?
Yeah, of course. So if they have the HELOC set up, that's ideal. It's probably the least expensive route. It's easy and it allows you to cash out more money of your existing primary. So the big difference between the HELOC and the HELOC allows you to take money from your current house, put it into the next house. The downside is that you have to qualify carrying both payments at the same time. If your
Mhm.
income is strong enough, amazing, good for you. That's the least expensive option. But let's assume that you're moving out of house A, going into house B, but both mortgage payments are too high to qualify. Your debt income ratios are too high. This is where a bridge loan comes in. You can purchase the next home on a bridge. We don't care what the DTIs are. All we care about is the final result. Once you sell home A and you only have home B and you refi home B, what's that debt to income ratio going to be? As long as it works, that's exactly what a bridge loan is for. Now, there's two types of bridge loans. There's a bridge loan cash out, which serves the same purpose as a HELOC, and there's a bridge purchase. A bridge purchase allows you to get the new property and acquire it, even though your DTIs are too high. And the bridge cash out allows you to do the exact same thing. But if you have a high income, HELOC is going to be your cheapest route.
Okay, great. So for my clients upgrading to a more expensive property, can you please explain what a mortgage recasting is? If they buy the new house now, but sell their old one 3 months later, how can they use those proceeds to lower their monthly payment without refinancing?
Yeah,
So can
so
we start by saying what mortgage recasting is?
the reamortization of your loan. As simple as that. So what you're based and recasting the new payment, reamortizing. So let's assume that you have $1 million loan. You sell your property and you want to put 200,000 into the proceeds 3 months later. Before you do that, you contact us. You say, hey, we want to do a recast. Here's $200,000. I want you to recalculate my payment on the new $800,000 balance. So we recalculate the payment. The whole process takes 2 to 4 weeks. And that's it. You don't have to refinance. There's a one-time $350 fee for the recast. And it's as simple as that.
Would think, and correct me if I'm wrong, but when it comes to mortgage recasting, I think of people that have been sitting in a property, say, for 15 years, and they come up, they come into a certain amount of cash, and they approach you. If they were going the traditional way of refinancing, they would basically go back to a 30-year loan.
30,
Where re
15, 10.
Right.
Yes,
So where recasting keeps that end period the same. Am I correct?
that is correct.
Okay.
Everything stays identical. So if you're on payment 257, you stay on payment 257. Now, an important caveat with the recast is that most banks will not let you recast more than 25% of the outstanding principal within the first 6 payments. Some do, most don't,
Why?
because they get something called an EPO, an early payoff. And the
Mm.
EPOs, we're going to get into something else when the loan is paid off too quickly and the back end margins are recuperated.
Well, let's just say that it sort of kills their business.
Correct.
Exactly, that's what I thought. Okay, in the DC metro area, standard family home often hits jumbo loan territory. Are
Mhm.
jumbo rates currently higher or lower than conventional rates? And what reserves, that is cash in bank, do my high net worth clients need to show to qualify?
Rates are about the same. Today they're about the same, and coincidentally, I know because I've already locked two loans, one jumbo, which is above 2 million, and the other one was at 212. Extreme, but they're exactly the same rate. The only difference was 0.125 points difference between them. The jumbo was a little bit lower.
Wow.
So they've been pretty par. I've been looking at some banks recently. One of my clients sent me the rates from a big bank. They were charging 6.625 at 0 points on a jumbo. They're about 6 1/8-ish right now, 6%. With excellent credit, you can get them under 6. So
Mhm.
it depends. And then the reserve requirements also depends on the loan amount, on the credit score, and on the strength of the file. Typically, with lower debt to income ratios and 80% LTV, 6 to 12 months is normal. If there are multiple properties involved, self-employed, and ratios are a little bit higher, you could see up to 24 months. I'd say an overwhelming 80% would be 12 months would be perfectly fine. Strong file, 6 months more than enough per property,
Okay.
per mortgage owned. So if you have
Okay.
5 mortgages, you grab all those 5 payments. Let's say it's $5,000 each. It's 30,000 times 6, and that's it. 180,000 is going to be a reserve requirement on 6 months for 5 properties at 5,000 each.
Okay. So a lot of my clients are business owners or consultants. Talk to me about portfolio loans or bank statement loans. How can clients qualify if their tax returns don't show their full purchasing power?
Yeah. Portfolio is a make sense loan. The loan makes sense. It just doesn't meet Fannie Mae, Freddie Mac, or jumbo guidelines. A
Okay.
perfect example are going to be non-warrantable condos. For example, if a condo doesn't meet all the requirements of Fannie Mae, Freddie Mac, but it's a good condo building, there's something that's a little bit off. It's a strong buyer, then portfolio loans take hold here. What they basically do is they give you a solution to financing where everything makes sense on the loan, but there's one guideline that we can't meet. For example, if there's something on a condominium, like there's a upcoming repair that hasn't been done. After the Surfside incident, condos have become much more scrutinized. And if there's an outstanding repair that was maybe identified 13 months ago but hasn't been done yet, then the condo can be non-warrantable. You won't be able to get Fannie Freddie financing on it. So a portfolio loan will say, well, everything is okay. This is not that big of a deal of a repair, and it's not necessarily in the area where affect our unit. So yes, we will accept a portfolio deal here because it makes sense. Another one may be a high net worth business owner that's buying a house and has significant amount of write-offs, but we can see the cash flow. We can see the money coming into the bank statements. We can see how the money's flowing, but because of the tax write-offs, they won't qualify. Here's where a portfolio loan takes hold again. It makes sense. We can see they make the money, but they don't check all the boxes for a standard conventional jumbo loan, for example.
Okay.
So
Okay.
they're make sense loans. As long as it makes sense and it's common sense, that's exactly what a portfolio is for.
Okay, cool. We are seeing a shift where sellers are more willing to offer concessions. If a seller offers $10,000 in credit, what is the most efficient way a buyer can use that? Is it better to cover closing costs or to buy down the rate permanently?
Depends who you talk to. For me,
Okay.
closing costs. A lot of lenders are going to say, oh, you have to
Closing
buy down the
costs.
rate. Yeah, you have to buy down the rate. It's the best thing. And it's because they don't want you to refinance the loan too soon. When a loan is refinanced before the initial 6 payments are made, banks get a penalty called an EPO, an early payoff. So loan officers typically will say, we want to push as many points as you can to disincentivize you from refinancing too soon. But quite frankly, what do you prefer, bird in hand? Uh, for me, it's bird in hand. I'd rather have all my closing costs paid up front. I can already see the direction of the market. We're going to see modest rate drops this year. Fannie comes out with an article every single month of forecast, and they're expecting 0.4% lower rate by the end of the year. Not a massive drop, but enough to warrant a refinance probably in 12 plus months from now. So I'd rather pay the $10,000 into closing costs, get the most bang for my buck right now, and be able to refinance 1 year from now a little bit more when rates drop. So why would I pay $10,000 into buying down the rate when I'm getting it for free in 1 year?
Okay, so I'm going to end with a couple of questions regarding where do you think the mortgage rates are going to stand in 2026?
It depends. Conventional conforming, probably 5.75 by the end of the year. Like I
Okay.
said, Fannie Freddie have a good forecast of 0.1% less per quarter. They're expecting 5.8. I think it's a bit conservative. Yeah, 5.8, 5.75 with 0 points towards the end of the year. Jumbos are probably going to be a little higher, 5.875. But by December, I think we're going to be slightly below 6% with 0 points across the board. FHAs were seen at 5.5 now with 0 points. So as of today.
Okay. And my last question is based on what you read and what you see and the information that comes across your desk. I have heard and read that home appreciation in this DC metro area is going to be slower than it has been in the past. What is your take on that?
I agree, and especially with condos. Um, there's supposed to be a modest appreciation in this area of 0.1 to 0.2%. Um, Based on what I'm seeing and tracking through the ratified contracts, I think that's going to be about right. I think we are going to see more inventory this year. I've had a lot of conversations with people that were qualified last year that are re-entering the buying pool this year because they feel that rates are going to come down. And I've also had a couple of conversations with some sellers that say this is the year where we're going to plan to sell. Regardless, we're going to lose our 2% rate, but we need to move and we need a bigger home. So I think there's going to be more activity this year.
Yeah, my problem with the overall market is the condo market. Condo market has been stagnant for the last couple of years. And when you have an avatar such as mine, which are homeowners that are downsizing, you enter a pool of potential condo sellers that are not willing to sell because they won't see their money back. So that's been my concern. And I also see stagnation coming up like in places like Fairfax, where there didn't used to be that kind of problem. So
Yep.
we'll see. Okay, very
I've
well.
seen
This has been great, Sebastian. I so appreciate your coming on, and I hope to see everybody on the next one. Bye.
Bye bye.